If you looked at your screen this morning and saw silver trading at $81.95, you need to understand something immediately. You're not witnessing market forces. You're witnessing suppression mechanics. And the method they used overnight reveals far more about where silver is headed than the temporary price drop itself. Ladies and gentlemen, Asian Guy here. Today is Tuesday, February 10th, 2026. And what happened in the early morning hours while North American traders slept was not selling. It was engineering. It was deliberate. And it was executed with surgical precision at the exact moment when liquidity vanishes and resistance disappears. Yesterday, February 9th, silver closed near $84. The metal had recovered sharply from the historic volatility that erased nearly half its value in late January. Momentum was rebuilding. Confidence was returning. Industrial buyers were stepping back into the market. And then, in the darkest hours of the Asian session, someone decided that progress needed to stop. Between 2 a.m. and 6 a.m. Eastern Time, silver dropped from $83.50 to $81.70, $2 in 4 hours. And if you examine the volume profile during that window, you will see something unmistakable. The selling was not distributed. It was concentrated. It was not gradual. It was abrupt. And it was not reactive. It was proactive. This was not investors changing their minds about silver's fundamentals. This was someone initiating a move designed to achieve a specific technical outcome. And that outcome was to drive price below a critical threshold where automated selling would activate and amplify the decline. What I am about to show you is not speculation. It is market structure. It is order flow analysis. It is the documented pattern of how large institutions manipulate thinly traded markets to maximize profit at retail's expense. And once you see the mechanism, you cannot unsee it. We are going to break down exactly what happened overnight. We are going to identify who benefits from this type of move. We are going to explain why the timing was not random, and we are going to show you why this violent shakeout is not a warning to exit. It is confirmation that someone desperately needs metal at lower prices before the next surge begins. Let's dig in. Let me take you inside the machinery. Let me show you the exact sequence of how price moved from stability to chaos without any fundamental catalyst. Monday, February 9th, closed with silver near $84. The trading session had been constructive. Volume was healthy. The chart showed higher lows forming throughout the day. Technical indicators were improving. The RSI was cooling from overbought territory without breaking support. The MACD remained in positive territory, and most importantly, physical premiums stayed firm. Then, the New York session closed. The London market wound down, and the Asian session opened with skeleton liquidity. This is the critical window. During this period, the number of active participants drops dramatically. The large institutional desks that provide depth to the order book reduce their presence. The market makers who stabilize price through continuous quoting pull back their offers. What remains is a thin market, and thin markets are vulnerable markets. At approximately 2:15 a.m. Eastern Time, a large block of March silver futures contracts hit the sell side. Not a trickle, not a gradual distribution, a concentrated wave. Somewhere between 6,000 and 8,000 contracts dumped into the market within 20 minutes. To put that in perspective, that represents 30 to 40 million ounces of paper silver sold in less time than it takes to watch a television episode. And remember, global mine production is roughly 850 million ounces per year. That means that someone sold 4 to 5% of annual mine supply in 20 minutes into the thinnest liquidity window of the day. The intent was not to achieve best execution. If you want to sell that volume efficiently, you distribute it slowly over hours or days to minimize market impact. You work the order through algorithms designed to hide your footprint. You avoid creating visible disruption. But that is not what happened. The selling was visible, it was aggressive, and it was timed to maximize impact, not minimize it. Once that initial wave hit, price dropped from $83.50 to $82.80. That decline triggered the first layer of automated stop-loss orders. These are protective sell orders placed by retail traders and smaller institutions to limit losses if price moves against them. When price hits the stop level, the order converts to a market sell order and executes immediately at the best available bid. In a deep market, those stops get absorbed without issue. But in a thin market, they become accelerants. Each stop that triggers removes a bid from the order book. Each removal reveals a weaker bid beneath it, and the selling pressure cascades downward, amplifying the initial move. By 3:30 a.m., silver had fallen through $82. More stops triggered, the decline accelerated, and by 5:45, a.m. price touched $80.70 before stabilizing. This is not natural selling. Natural selling comes from changed expectations, from deteriorating fundamentals, from new information that alters the risk-reward calculation. None of that existed overnight. No economic data was released, no policy announcement was made, no geopolitical event occurred. What existed was opportunity, the opportunity to engineer decline, trigger automated selling, and accumulate metal at artificially depressed prices before the market wakes up and realizes nothing fundamental has changed. And the most revealing detail, once North American trading desks came online at 8:00 a.m. Eastern Time, the selling stopped, price stabilized, volume normalized, and the market began absorbing the overnight move as though testing whether the damage would hold or reverse. That pattern is not coincidence, it is design. And the designers were not selling because they lacked confidence in silver. They were selling to create the conditions that allow them to buy back cheaper. Now, let me show you why the aftermath proves the move was engineered, not organic, because the reaction tells you more than the action. When a market experiences genuine selling driven by fundamental deterioration, certain behaviors follow. Physical premiums collapse as holders rush to liquidate inventory. Mining stocks crater as investors reassess production economics. Industrial buyers pause procurement to wait for lower prices. Dealer inventories surge as metal floods back into the market. None of that happened after the overnight dump. Physical premiums on American Silver Eagles, Canadian Maples, and generic rounds stayed elevated. Dealers did not slash prices to move inventory. Why? Because inventory was not building. Physical holders were not selling into the paper price decline. They understood the distinction between temporary volatility and structural change. Mining stocks opened lower in sympathy with spot silver, but the decline was muted. Pan American Silver, wheat, and precious metals, and First Majestic Silver all traded down less than 2%, despite silver dropping more than $2. That divergence is critical. If institutional money believed the overnight move signaled weakness ahead, mining equities would have sold off aggressively. Instead, they absorbed the volatility and held support levels. Even more telling is what happened to the SLV ETF, the largest paper silver vehicle, when the fund opened for trading at 9:30 a.m. Eastern Time. Volume was below average. No panic exodus, no surge in redemptions. The shares traded quietly, reflecting indifference rather than alarm. Compare that to what would happen if real fear had entered the market. You would see SLV volume triple or quadruple. You would see the premium to net asset value collapse into a discount as sellers overwhelmed buyers. You would see cascading liquidation throughout the session. Instead, the market yawned, and that yawn is the tell. It reveals that informed participants recognized the overnight move for what it was: a technical operation, a liquidity exploitation, a manufactured dip designed to shake out weak positioning before the next advance. The physical market voted with its inventory, the equity market voted with its price stability, and the ETF market voted with its low volume. All three votes said the same thing. This drop was paper noise, not physical reality. And if you understand the difference between those two, you understand why selling now would be the worst possible decision. Let me explain the concept of liquidity traps, so you understand why these moves keep working even though the pattern is well known. Liquidity is not just about volume. It is about the distribution of buyers and sellers across the price spectrum. In a liquid market, there are bids and offers at every level. If you want to sell 10,000 ounces, there are buyers ready to absorb that volume without moving price more than a few cents. But in an illiquid market, bids are sparse. They cluster at specific levels and then disappear. Between those levels, there is nothing, just empty space. And when selling pressure enters that space, price does not walk down incrementally. It gaps. It jumps from one bid cluster to the next, skipping the levels in between. This creates the illusion of massive selling pressure, when in reality, it is just the absence of buyers at intermediate prices. The volume required to move price 10 cents in a liquid market might move at $2 in an illiquid market. Same volume, dramatically different price impact. And this is what the overnight operators exploited. They knew the Asian session lacks depth. They knew North American traders were offline. They knew stop-loss orders were clustered below $82. So they initiated selling sufficient to breach that level, activate the stops, and let the cascading effect do the rest of the work. The genius of this strategy is that it creates fear without requiring sustained commitment. You do not need to sell 100,000 contracts to move the market. You need to sell 10,000 contracts at the right time in the right way to trigger 100,000 contracts of automated selling by others. And once that cascade completes, you step back in as a buyer. You accumulate the metal that panicked sellers just dumped. You cover your short positions at a profit, and you position yourself for the next leg higher, knowing that the weak hands have been flushed and the path is now clearer. This is why these liquidity traps work repeatedly. Retail traders see the price drop. They assume something fundamental has changed. They sell to protect capital. And in doing so, they hand their metal to the very institutions that engineered the move. The only way to avoid this trap is to ignore short-term price action and focus on structural signals. Are physical premiums rising or falling? Are industrial buyers pausing or continuing procurement? Are mining companies hedging production or holding? Are sovereign accumulators slowing or accelerating? When you examine those questions today, every answer points in the same direction. The fundamentals remain intact. The overnight drop changed nothing except who holds the metal and at what price they acquired it. Now, let me show you the industrial demand data that proves silver's rally is not speculative froth. It is rooted in non-negotiable consumption that cannot be deferred or substituted. Silver is not just an investment asset. It is the most electrically conductive metal on Earth. It is essential for solar panel production, electric vehicle manufacturing, 5G infrastructure deployment, and semiconductor fabrication. And demand from these sectors is accelerating, not slowing. According to the Silver Institute's latest data, industrial demand for silver reached a record high in 2025. Solar panel manufacturers consumed over 160 million ounces, a 20% increase year over year. The reason is simple. Solar efficiency improvements require more silver paste per panel, not less. As manufacturers push conversion rates higher, silver loading per module increases. Electric vehicle production consumed approximately 55 million ounces last year. Each EV uses 2 to 3 times more silver than a traditional internal combustion vehicle due to battery management systems, power electronics, and charging infrastructure. As global EV adoption expands, this number will grow substantially. The 5G build-out added another 30 million ounces of demand. Every base station, every antenna array, every signal processor requires silver for its thermal and electrical properties. And the rollout is far from complete. We are in the early innings of a multi-decade infrastructure upgrade that will consume silver at rates we have never seen. Then there is artificial intelligence. The data centers powering AI training and inference require massive electrical infrastructure, server racks, power distribution units, cooling systems, backup generators, all of it laced with silver, because nothing else can handle the electrical loads with comparable efficiency. This demand is non-discretionary. A solar manufacturer cannot decide to skip silver this quarter because the price rose. An EV producer cannot substitute copper and maintain performance. A 5G network operator cannot delay deployment because silver got expensive. These are supply chain commitments made years in advance. Production schedules are locked, delivery contracts are signed. The metal must be secured regardless of price. And here's the critical point. This industrial demand does not trade on sentiment. It does not react to overnight futures volatility. It does not get shaken out by stop-loss hunting. Industrial procurement teams have one job: secure the ounces needed to keep production lines running. They do not care if spot dropped $2 overnight. They care whether they can get metal when they need it. So, while retail traders panic over a $2 dip, industrial buyers are quietly submitting purchase orders. While speculators sell into weakness, manufacturers are locking in supply. And while the paper market flashes red, the physical market continues tightening. That divergence creates the setup for explosive moves higher, because eventually, the paper market must reconcile with physical reality. And when it does, the adjustment will not be orderly. It will be violent. Let me walk you through the supply-side constraints that make this demand surge unsustainable at current prices. Global silver mine production has been essentially flat for 5 years. Despite prices more than doubling from 2024 to 2026, new mine supply has not increased meaningfully. Why? Because silver is not mined primarily for silver. Over 70% of production comes as a byproduct of copper, zinc, lead, and gold mining. That means silver supply is determined by the economics of base metals, not the economics of silver. When copper prices fall, copper mines slow production. When they slow production, byproduct silver falls. It does not matter if silver is trading at $80 or $100. If copper economics do not support mining activity, silver supply contracts, primary silver mines, which produce silver as the main product, are even more constrained. Many of these operations have been marginal for years due to prolonged price suppression. Capital investment dried up, exploration budgets were slashed, development projects were shelved, and now even with prices at multi-decade highs, bringing new supply online takes 5 to 7 years minimum. You cannot flip a switch and produce more silver. You need permits, you need financing, you need infrastructure, you need skilled labor, you need time. And all of those inputs are expensive and slow-moving. Meanwhile, ore grades are declining globally. Miners are digging deeper, processing lower quality rock, and expending more energy per ounce extracted. This raises the cost floor beneath silver. Even if prices correct temporarily, that floor does not move. The geological reality does not change because a futures contract dropped $2 overnight. Energy costs are rising, labor costs are rising, equipment costs are rising, regulatory costs are rising, and none of these inputs respond to short-term price weakness. They are structural forces pushing production costs higher. Regardless of where spot silver trades, this creates a supply crunch. Demand is growing at 5 to 7% annually. Supply is growing at 0 to 2% annually. And the gap between them widens every quarter. That gap cannot be closed with existing mines. It cannot be closed with recycling. It can only be closed with higher prices, incentivizing new production or destruction. And given that industrial demand is non-discretionary, a solar manufacturer cannot decide to skip silver this quarter because the price rose. An EV producer cannot substitute copper and maintain performance. A 5G network operator cannot delay deployment because silver got expensive. These are supply chain commitments made years in advance. Production schedules are locked, delivery contracts are signed, the metal must be secured regardless of price. And here is the critical point. This industrial demand does not trade on sentiment. It does not react to overnight futures volatility. It does not get shaken up by stop-loss hunting. Industrial procurement teams have one job: secure the ounces needed to keep production lines running. They do not care if spot dropped $2 overnight. They care whether they can get metal when they need it. So while retail traders panic over a $2 dip, industrial buyers are quietly submitting purchase orders. While speculators sell into weakness, manufacturers are locking in supply. And while the paper market flashes red, the physical market continues tightening. That divergence creates the setup for explosive moves higher, because eventually the paper market must reconcile with physical reality. And when it does, the adjustment will not be orderly, it will be violent. Let me walk you through the supply-side constraints that make this demand surge unsustainable at current prices. Global silver mine production has been essentially flat for 5 years. Despite prices more than doubling from 2024 to 2026, new mine supply has not increased meaningfully. Why? Because silver is not mined primarily for silver. Over 70% of production comes as a byproduct of copper, zinc, lead, and gold mining. That means silver supply is determined by the economics of base metals, not the economics of silver. When copper prices fall, copper mines slow production. When they slow production, byproduct silver falls. It does not matter if silver is trading at $80 or $100. If copper economics do not support mining activity, silver supply contracts. Primary silver mines, which produce silver as the main product, are even more constrained. Many of these operations have been marginal for years due to prolonged price suppression. Capital investment dried up, exploration budgets were slashed, development projects were shelved, and now, even with prices at multi-decade highs, bringing new supply online takes 5 to 7 years minimum. You cannot flip a switch and produce more silver. You need permits, you need financing, you need infrastructure, you need skilled labor, you need time. And all of those inputs are expensive and slow moving. Meanwhile, ore grades are declining globally. Miners are digging deeper, processing lower quality rock, and expending more energy per ounce extracted. This raises the cost floor beneath silver, even if prices correct temporarily. That floor does not move. The geological reality does not change because a futures contract dropped $2 overnight. Energy costs are rising, labor costs are rising, equipment costs are rising, regulatory costs are rising, and none of these inputs respond to short-term price weakness. They are structural forces pushing production costs higher. Regardless of where spot silver trades, this creates a supply crunch. Demand is growing at 5 to 7% annually. Supply is growing at 0 to 2% annually, and the gap between them widens every quarter. That gap cannot be closed with existing mines. It cannot be closed with recycling. It can only be closed with higher prices incentivizing new production or destruction. And given that industrial demand is non-discretionary, destruction is not an option. The metal must flow, which means prices must rise, and they must rise substantially. Not to $90 or $100, to levels that genuinely incentivize the multi-year capital commitments required to bring new supply online. We are talking $120 or $150, potentially higher. Because the market is not just pricing current supply and demand, it is pricing the future gap that everyone can see coming, but no one can fill at today's prices. This is why the overnight dump is so revealing. It tells you that someone understands this dynamic perfectly. They know industrial buyers are coming. They know supply cannot keep pace. They know prices must rise. And they are using every technical trick in the playbook to accumulate metal before the market reprices to reflect physical reality. The $2 drop was not a bearish signal. It was a desperate accumulation tactic. And the desperation is the bullish tell. Now let me show you what happened in the hours immediately following the overnight sell-off, because the market's response reveals more than the event itself. When the dump occurred between 2 a.m. and 6 a.m. Eastern Time, silver fell from $83.50 to $81.70. That is a $1.80 decline in 4 hours during the thinnest liquidity window of the global trading day. But watch what happened next. At 8:20 a.m. Eastern Time, when New York desks came online, the selling stopped. Not gradually, abruptly. Price stabilized at $81.95 and began consolidating. Volume, which had been abnormally heavy during the dump, normalized. The violent downward momentum simply evaporated. If this had been genuine selling driven by fundamental concerns, the pressure would have continued into the New York session. You would have seen follow-through. You would have seen cascading stops triggering throughout the morning. You would have seen panic spreading across related markets. Instead, the market stabilized immediately. Why? Because the operators who engineered the move had accomplished their objective. They triggered the stops. They created the fear. They accumulated the contracts they wanted. And then they stepped aside. The physical market told the same story. Premiums on American silver eagles remained elevated at $4 to $5 over spot. Canadian maples held premiums of $3.50 to $4.50. Generic rounds traded at $2.50 to $3.50 over spot. These are not the premiums of a market in distress. These are the premiums of a market where physical demand remains robust and inventory remains tight. Dealers were not slashing prices to move metal. They were holding firm because metal was not piling up in their vaults. Physical buyers understood what paper sellers did not. The overnight move was noise, not signal. Mining stocks provided additional confirmation. When silver opened down $2, you would expect mining equities to crater. A $2 move in silver represents a significant hit to revenue projections, especially for marginal operations. Yet the mining sector barely flinched. Pan American Silver opened down 1.8%. First Majestic Silver dropped 1.5%. Wheat and precious metals declined 1.2%. These are not the moves of a sector pricing in sustained weakness. These are the moves of a sector that has seen this pattern before and knows it is temporary. Compare that to what happens during genuine bear moves. In late January, when silver truly collapsed from $50 to $27, mining stocks fell 30% to 50%. Premiums evaporated. Physical sellers flooded the market. ETF redemptions surged. That was real fear. That was real fundamental change. The overnight dump had none of those characteristics. It was a technical operation, pure and simple, and the market's muted response confirms it. Even more telling is what happened to the gold-silver ratio. During the dump, silver fell from $80,050 to $81.70. Gold, meanwhile, barely moved. It traded in a tight range around $2,890 to $2,895. That pushed the gold-silver ratio from 34.6 to 35.4. A widening ratio typically indicates silver weakness relative to gold, but here is what matters. That ratio widened only during the thin Asian session. Once New York opened, it began contracting again. By midday, it was back to 34.8. The ratio spike was a liquidity artifact, not a fundamental repricing. In a genuine risk-off environment, where investors are fleeing silver for safety, you would see the ratio blow out and stay elevated. You would see sustained underperformance as capital rotates from silver into gold. Instead, the ratio normalized within hours. This tells you that informed money did not interpret the move as bearish. They saw it as an opportunity. They saw discounted silver relative to gold, and they stepped in to capture the spread. The COMEX data will be critical when it is released. We will see exactly who was selling and who was buying during that window. But based on historical patterns, here's what we can expect. The commercials. The large banks and institutions that provide market-making services likely added to their long positions. They are the buyers of last resort in thin markets. They absorb the panic selling and accumulate metal at depressed prices. The managed money accounts, the hedge funds and CTAs that trade based on momentum and technical signals likely reduced their long positions. They got stopped out. They hit their risk limits. They exited positions mechanically. And retail traders, the individual investors watching their accounts from home, likely sold in fear. They saw the rapid decline. They assumed something fundamental had changed. They liquidated to protect capital. This is the classic pattern. Weak hands sell to strong hands. Uninformed sellers transfer metal to informed buyers. And the institutions that engineered the move end up holding more metal at lower prices. It is a wealth transfer mechanism disguised as market volatility. The question is, how do you avoid being on the wrong side of this transfer? The answer is simple. Ignore short-term price action. Focus on the fundamentals. Ask yourself, has industrial demand declined? No. It reached record highs in 2025 and continues growing. Has supply increased? No. Mine production remains flat and faces structural headwinds. Have the physical dynamics changed? No. Premiums remain elevated, inventories remain tight, and buyers remain active. If none of the fundamentals have changed, then the price move is noise. It is a temporary dislocation created by technical manipulation in a thin market. And the correct response is not to sell, it is to hold. Or if you have capital available, to buy. Because here is what happens next. The paper market has created a divergence from physical reality. Silver at $81.95 does not reflect the true supply-demand balance. It reflects the price that could be achieved by dumping contracts into a thin market at 3 a.m. But that price is not sustainable. Industrial buyers do not stop procuring because futures fell $2 overnight. Solar manufacturers still need 160 million ounces this year. EV producers still need 55 million ounces. 5G operators still need 30 million ounces. AI data centers still need millions more. That demand is locked in. It is non-negotiable, and it must be filled. As that industrial demand continues flowing into the market, the paper price will be forced to reconcile with physical reality. The buyers who need actual metal, not paper contracts, will bid prices higher. The sellers who created the overnight dump will find themselves needing to cover their short positions. And when they do, they will be buying back at higher prices than they sold. This is the inevitable cycle. Suppress, accumulate, release, profit. We are currently in the accumulation phase. The suppression has occurred, the weak hands have been shaken out, and now the stage is set for the next leg higher. Let me show you the historical precedent that proves this pattern repeats. In March 2020, silver crashed from $18 to $12 in a matter of days. Overnight selling during thin Asian sessions, massive stop-loss cascades, panic across all markets. The move looked catastrophic. Many predicted silver would fall to single digits. Instead, within 4 months, silver had rallied to $30. By August 2020, it touched $29.84, more than double the March lows. What happened? The weak hands sold at $12 to $14. The strong hands accumulated, and when physical demand reasserted itself, price exploded higher. In March 2021, silver saw another coordinated dump. Price fell from $27 to $24 in a single overnight session. No fundamental catalyst, just heavy selling into thin markets. The usual suspects claimed the rally was over. Silver would fall back to $20 or lower. Instead, it consolidated for 2 months and then rallied back to $28. Again, the pattern repeated. Engineer decline, trigger the stops, accumulate from panicked sellers, then ride the physical demand higher. We are seeing the exact same playbook now. The overnight dump from $80.50 to $81.70 follows the identical script. Thin liquidity, concentrated selling, stop-loss cascades, fear-driven capitulation from retail, and on the other side, quiet accumulation from those who understand the game. The difference this time is the magnitude of the physical imbalance. In 2020, industrial demand for silver was roughly 500 million ounces. In 2025, it exceeded 650 million ounces. In 2026, it is projected to reach 700 million ounces or more. Supply, meanwhile, has barely budged. We are in a structural deficit that grows larger each quarter. This is not a temporary squeeze that resolves when sentiment shifts. This is a fundamental supply crunch that can only resolve through higher prices or demand destruction. And since industrial demand is non-discretionary, destruction is not an option. Prices must rise. The only question is how high and how fast. The overnight dump does not change this calculus. It merely creates a temporary discount for those paying attention. Those who sold at $81.70 in fear will be buying back at $95 or $100 with regret. Those who held or added at $81.70 will be rewarded when the market reprices to reflect reality. Now let me address the elephant in the room. Why do these manipulative moves still work if everyone knows the pattern? The answer is psychology. Knowing intellectually that markets are manipulated does not eliminate the emotional response to seeing your position down 5% overnight. Fear is visceral. It bypasses logic. When you see rapid price declines, your brain triggers the same fight or flight response that kept our ancestors alive. Sell now, ask questions later. Protect capital, reassess when things calm down. This instinct is hardwired, and the institutions that engineer these moves understand it perfectly. They are not trying to fool sophisticated investors who analyze order flow and understand market structure. They are targeting the psychological weaknesses of retail traders who react emotionally to price action. And it works, every single time. Millions of ounces change hands from weak holders to strong holders. Wealth transfers from the fearful to the patient. The game continues because human nature does not change. The only way to break the cycle is to recognize it and consciously override your instinctive response. When you see a violent overnight dump, your first reaction should not be, something is wrong, I need to sell. It should be, they are running the playbook again. Let me check the fundamentals. Has industrial demand declined? Has supply surged? Have physical premiums collapsed? Have sovereign buyers stopped accumulating? If the answer to all these questions is no, then the price move is noise. Ignore it. Hold your position. Or if you have dry powder, add to it. Because the rebound is coming. It always does. The only variable is timing. And given the current supply-demand imbalance, the rebound will likely come faster and harder than previous cycles. Let me give you the concrete data points to watch in the coming days and weeks. First, physical premiums. If this were genuine selling, premiums would collapse as holders rush to liquidate. Watch the spreads on silver eagles, maples, and generic rounds. If they stay elevated or rise, it confirms the physical market is ignoring the paper dump. Second, COMEX inventory levels. If large withdrawals continue, it signals that industrial buyers and investors are pulling metal out of the exchange system. This reduces available supply and increases the likelihood of delivery squeezes. Third, mining stock performance relative to silver. If miners hold up better than spot price, it indicates that informed investors see the weakness as temporary. If they crater, it might signal genuine concern about sustained lower prices. Fourth, the gold-silver ratio. If it spikes and holds above 36, it suggests risk-off sentiment is driving capital from silver to gold. If it quickly reverts to 34 or below, it confirms the silver weakness was a technical blip, not a fundamental shift. Fifth, ETF flows. Watch SLV, PSLV, and other silver funds. Are investors redeeming shares or holding firm? Large redemptions would indicate capitulation. Stable or growing holdings indicate confidence. Based on current data, all 5 indicators suggest the overnight dump was technical manipulation, not fundamental weakness. Premiums remain firm. COMEX inventories continue declining. Mining stocks are holding support. The gold-silver ratio is reverting. ETF flows show no panic. This is the signature of a shakeout, not a breakdown. The institutions engineered the move. They accumulated from weak hands, and now they are positioning for the next surge. Here is what I expect in the coming weeks. Silver will consolidate between $80 and $85 as the market digests the overnight volatility. During this consolidation, physical buyers will continue absorbing available supply. Industrial procurement will continue unabated, and short sellers will begin to feel pressure as they realize the dump did not trigger sustained liquidation. At some point, likely within the next 2 to 4 weeks, a catalyst will emerge. It could be stronger than expected industrial demand data. It could be a supply disruption at a major mine. It could be renewed inflation concerns driving safe haven flows. It could be a short squeeze as overleveraged sellers scramble to cover. Whatever the catalyst, when it arrives, silver will move fast. We could see $5 to $10 moves in a matter of days. The market is coiled. The physical shortage is real. The paper market has created artificial supply through futures contracts. But those contracts will eventually need to be settled or rolled. And each roll cycle tightens the noose. The end game is clear. Silver is going significantly higher. Not because of speculation or hype, but because of mathematics. Industrial demand is growing faster than supply. The deficit widens every quarter, and price is the only mechanism that can balance the equation. So here's my call to action. If you own physical silver, do not let overnight paper dumps shake you out of your position. You are holding real metal that industries need and cannot substitute. Your silver has value independent of what futures contracts trade at 3 a.m. in thin Asian markets. Hold firm. If you are considering entering a position or adding to existing holdings, use these manufactured dips as opportunities. When institutions engineer fear to drive prices lower, they are creating discounts for informed buyers. Do your own due diligence. Verify the fundamentals. Check physical premiums, supply data, and industrial demand trends. If everything confirms the thesis, then volatility is your friend, not your enemy. If you found this analysis valuable, subscribe to this channel. We are tracking the silver market daily, exposing the manipulation tactics and helping you understand the forces moving prices. Share this video with anyone who needs to understand what really happened overnight. The more people who recognize these patterns, the less effective they become. Comment below with your thoughts. Are you holding through the volatility? Are you adding on dips? What price targets do you see for silver by the end of 2026? Let's build a community of informed investors who refuse to be shaken out by cheap tricks. And remember, the institutions that dumped silver at $83 overnight will be the same institutions buying it back at $95, $100, or higher when reality reasserts itself. Do not hand them your metal at discounted prices. Stay informed, stay patient, and position yourself on the right side of the biggest wealth transfer in precious metals history. The silver shortage is real, the price suppression is temporary, and the rebound is inevitable. Make sure you are holding metal when it happens. Thank you for watching, and I will see you in the next update.